Hey everybody, today I want to share one of my favorite investment mechanisms with you, and it's perfect for college students, for new professionals, for those that are working part-time, and those that are working in an industry where the salary has been compressed. And what I'm talking about is a Roth IRA. Now in this video, what I hope to accomplish is I'm going to tell you what the Roth IRA is. I'm going to give you an example, and then I'm going to walk through the different requirements for the Roth IRA, which includes things such as the need for earned income, the income requirements, the income limitations, the maximum that you can contribute to a Roth IRA, some phase-out amounts, and some of the unique things that you can do with a Roth IRA. So that's the focus of this video. Now, before I get into it, let me just give you an overview so you can kind of see how this is going to work and decide whether this video is even for you. So with a Roth IRA, what happens is you have some earned income. You've worked, you've earned that money, you've paid taxes on it, or you're going to be having to pay taxes on it. And what you're doing is you're taking an investment and you're contributing it into a Roth IRA after tax. Now, if your income is lower for the year, then if you're below the standard deduction, and I have a full video on the standard deduction that you can check out, but if your income is below the standard deduction, you're probably not going to be paying any taxes on it anyways. So you're going to invest it into this Roth IRA, and then all the growth that's going to occur is going to be tax-free. You're never going to pay taxes on that. So let me give you an example. Let's say that we have a college student, they're first year in college, or 18 years of age, and their parents are helping them pay their living costs, right? So the parents are paying over half of the support for the student. And what we have is our student that's going to go ahead and get a part-time job. And let's say that our student earns $10,000 this year. So our student decides, since parents are helping pay for their living expenses, that they want to invest that money. And what they can do is they can invest it in just mutual funds right now. Or perhaps what they can do is they can put it in a Roth IRA. And a Roth IRA is very easy to set up. So let's say that they take the approach of the Roth IRA. Well, what's going to happen is they have to pay taxes on the money that they earned, and then they're going to contribute it. Well, with the amount of money they earned at $10,000, their standard deduction is going to cover that. They're not going to have a tax liability. So they're paying 0% today on those wages that they're going to go ahead and contribute into this Roth IRA. Now, if they invested in the Roth IRA and the Roth IRA brings in, say their investments bring in a lifetime return of 11%. So they're averaging 11% return all the way through their entire investment life. And they're not going to take this out, their investment out, until they're age 67 because they want to save for retirement. Well, because of time value of money, I mean, we're looking at investing at 18 and you're not touching it for about 50 years. So how much do you think that is going to be by the time they hit retirement? That's $7,000. We're going to say they're investing $7,000 today, which is the max that you can contribute to a Roth IRA. So they invest $7,000 today and they don't touch it until they turn 67 years of age. And they don't ever invest another penny in this. It's just a one-time, hey, here it is, I'm done, and let's just let the growth take off from there. All right, well, if you said it's over $1 million, you're absolutely right. So their investment would be worth $1 million, over $1 million, by the time they hit retirement age. Now, of course, there's inflation, and the money, $1 million when you're 67 or 50 years from now is going to be different than $1 million today. So I grant you that. But for purposes of this illustration, when they withdraw that $1 million, right, over $1 million, they don't pay taxes on it. They don't have to pay taxes. So when they invested it, because they're under the standard deduction, they didn't pay taxes. All that $1 million of growth, they're taking that out tax-free as well. They've never really had to pay taxes on it because they're under the standard deduction. And under a Roth, you don't pay taxes when you withdraw. So that's why I like the Roth IRA so much, especially with clients that are just beginning their careers or that may not be in a lucrative career, that they may be doing it because it's a passion of theirs or for whatever reason. So I'm going to go ahead now and I'm going to start walking you through the different requirements of the Roth IRA so you can see, hey, do I qualify and is this the right tool for me? So we'll start out with the table that shows you how you do this. And then I'll go ahead and I'm going to walk you through the income requirements because there's a threshold and there could be a phase out amount. And I'm going to show you what happens if you make too much money to qualify for the Roth IRA. So let's go ahead and start looking at those requirements. So what we're looking at are the requirements for both 2025 and 2026. Now you're going to notice that between the 2025 and the 2026 years, they're pretty much the same, except when we get to contribution limits and income phase outs, and that's where we're going to see some changes. So as I was saying, in terms of tax treatment, when you have a Roth IRA, you contribute after tax, meaning it's subject to tax with your earned income. You pay taxes on your earned income at your tax rate, and then you go ahead and you make that contribution. And what will happen is it will then grow tax-free, and you're going to be able to take out your investment and all that interest and not pay taxes on it again, even with that growth. So if we went from a $7,000 contribution, we pay our taxes on anything that we would have on the $7,000. And then what we're going to do is we're going to take a withdraw at our retirement age or whenever we choose to take that. And that $1 million of investment isn't going to be taxed. Now, it's not going to be taxed as long as you don't take the contribution out before you're going to be 59 and a half years of age. If you do that, then you're subject to a 10% penalty, although there are certain exceptions that help you avoid that penalty. But that would be the impact of it. So you're generally looking at 59 and a half. Now, if you were going with a traditional IRA, what would have happened is that $7,000 would have been removed from your taxable income. And then all that growth, the $1 million of growth, eventually you're going to be paying taxes on your initial contribution plus the $1 million of growth in retirement. And if you're in a higher tax bracket at that point, because you have all your other investments coming in and everything like that, maybe you have some rental income coming in, maybe you have a pension if you're an employer that still offers a pension, you have your Social Security plus your 401ks or whatever else you have in there, right? They're all coming together. You may be in a higher tax bracket than you are currently. So that's the tax treatment for it. Now, in order to capitalize on this, we have certain requirements. Okay, the first one is you have to have earned income, which that means if your income is simply coming from more of a passive investment, is from dividend income, is from gifts, is anything like that, hey, that does not work. Okay, investment income, passive income, that does not work. It has to be earned income. You have to have a job. You have to earn that income. Now, if you earn that income and your parents also gave you some money, that for living expenses, you could take your portion of the earned income and you could invest that in a Roth IRA if you didn't need it and your parents are supporting you or your roommate's supporting you or whoever's supporting you. You could do that. That's fine, but you cannot contribute more than your earned income. So there's a limit as far as, first off, you have to have earned income, and then there's a limit that says you cannot contribute more than the amount of earned income than you had. So if you only earned $4,000 and your parents gave you $10,000, you can't contribute all $7,000 that you'd normally be allowed to in 2025. You're only going to be able to contribute the amount of money that you earned from your salary, from your wages. Okay, so that's going to be the first two requirements that you have there. The next thing is looking at the contribution limits. So this is where 2025 and 2026 differ, the years for the contribution limits. And this is normal. They increase with inflation and everything else. But for 2025, so if you're looking at making a contribution this year, what you're looking at is $7,000 if you're under the age of 50. Once you hit 50, it increases up to $7,500 as a catch-up provision. So you can contribute earned income up to $7,000. That's your ceiling. That's the max. Unless you're 50, then it jumps up to $7,500. Next year, so when you file taxes in 2027, so for the tax year of 2026, you file in 2027, it jumps up to $7,500 if you're under 50, and then $8,600 if you're 50 or older. Okay, so we see that our income contributions are going to increase. Now, there are some additional income requirements as far as that's the contribution limits, but now some income phase outs. So if you're a high income earner, you may have to do a different approach to get to a Roth IRA. There's something called a backdoor Roth IRA, and you could use that approach if you really want to do it. So when somebody tells you, hey, I make too much to contribute to a Roth, well, yeah, traditionally you do, but you can do a backdoor Roth IRA and you can still accomplish the same things. It avoids some of the other requirements. It falls outside the scope of this video. If I get enough interest, I will do a video on the the backdoor Roth IRA for you. But our contribution or our income phase out amounts are for single and head of household, 150,000 to 165. So what does that mean? That means if you make under $150,000 and you're single or you're the head of household, your filing status is head of household, you can take that full $7,000, assuming you have the earned income of at least $7,000. You can take the full thing. It's not going to be phased out. If you make between 150 and 165, so there's that $15,000 phase out period. If you make within that period, now we're going to have to reduce the amount. We won't get the full $7,000. There's going to be a reduced amount, but we still are eligible to contribute some to our Roth IRA. And if we made over $165,000, we're out of luck. We're going to go backdoor Roth IRA. We'll get it taken care of that way. Phase out amounts for married filing jointly. You can see that it's going to be the 236 to 246. So we have the additional amounts on there. Now in 2026, the amounts went ahead and increased, right? So single head of household is going to be 153 to 168. So it's been an increase of about $3,000. And then you can see for married filing jointly, it goes 242 to 252. So the range for married filing jointly is still going to be 10,000. The range for single or head of household is still going to be 15,000. But you'd be able to contribute all the way up till you start hitting the phase out range without any reduction in your max. And then once you exceed that phase out amount, you aren't going to get anything. So if you had, say, in 2026, you had $169,000 of salary, then, hey, you're out of luck because you fall outside the phase out range. So you're completely phased out at that point. So let's look at some additional requirements here for you. And I'm going to go ahead and scroll up on here so we can see what else we have. We got two more, and I'll get that set up so hopefully we can see it pretty well. And what we're going to do, let me just get you out of the get me out of your way for you, is we're looking at the withdraw. Okay, and I talked about these withdraw requirements before. So generally, we're not able to withdraw from a Roth IRA until we're at least 59 and a half years of age if we don't want to have to pay the 10% penalty in tax, right? So if we take it before that 59 and a half, that's what we're looking at. Although there were exceptions that I told you before. Some of the exceptions are going to be education, first home, disability, and there's some others out there as well. That's the same between 2025 and 2026. Those rules don't change. So that 59 and a half has been that way for a while. The other thing that is worth noting on here, you can take out your contributions, but not the growth portion, and avoid that 10% in the taxes. But another big thing is no required minimum distributions. That's what my RMD stands for on this table. There is no required minimum distribution. So if you go with a traditional IRA, what happens is as you get into your 70s, you start having to take out required amounts every year. And you're taxed on it, right? Well, that doesn't occur when you have a Roth IRA because you're not going to have any taxes on it anyways. So you don't have those RMDs, which is a huge deal for retirees. So those of you that are thinking of starting to contribute, that's a big deal, okay? Other things, other considerations. So no minimum age. A 16-year-old, you're working, you can do this now, okay? Or if you have a child who's working and doing these things, they can start contributing right now. Maybe they even work for your business and they're earning a salary. Hey, you can have that salary. They can go ahead and invest in a Roth IRA up to the extent of the money they're making. If it's $7,000, they can go ahead and they can contribute the $7,000. Another thing, as you're going through, you're not paying taxes. Like, you don't have to worry about capital gains capital losses. You don't have to worry about wash sales, anything like that when you're making these trades within the Roth IRA. If you have dividend investments and they're dividend stocks that keep paying dividends, right? You're not paying any taxes on that. It just sits in the Roth IRA and it continues to grow. So you don't have to worry about paying taxes every single year on these things. And something else I wanted to point out is a question I often receive is, well, hey, how do I invest? I mean, how do I know what I'm going to invest in? What can I do? Well, there's all kinds of different companies that allow you to do it. Banks will allow you to do it. There's all kinds of ways to do a Roth IRA. And if you're interested and I get some comments on that, I can walk you through the process of how to set up a Roth IRA and what to look for. But what I wanted to mention specifically is that with the Roth IRA, you can actively trade stocks. It's not like you just put the money in and now you're gone. If you wanted to trade them every single day, you could do that, right? You can sit there and maybe you're using Fidelity or E-Trade or whatever. You can go ahead and you can make your trades on there, and that's not going to be subject to taxes, right? You don't have to worry about, hey, well, I have a gain on this one, I have a loss on this one. None of that applies, right? Now, you may have some brokerage fees. It depends on the company that you're working on. Many of them don't have brokerage fees on that anymore, so you're able to make those trades anyways within limitations. So you're able to take that approach. All right, I want to do one more thing for you. What I want to do is I want to walk through a example to where you have a phase-out amount and your income salary falls within that phase-out amount, because I want to be able to show you how you're going to determine what the maximum contribution is when your income falls within that. Because we know if your income is below the phase-out amount, you get the full $7,000. At least this year is $7,000. If your income's over the phase-out, we know you don't get anything, right? You don't get anything. So what happens if you fall within that phase-out? And I'm going to walk you through that problem, and then we will wrap up for this video. So let's go ahead and take a look at that. So what we're looking at on this problem is Amy, age 42, files as single and earns a modified adjusted gross income of $158,000 in 2025. How much can Amy contribute to a Roth IRA for 2025? All right, well, let's take a look at it. She's under age 50, so we don't get the catch-up provision. We're stuck at $7,000 max for 2025, right? So this is what happens when we're doing our taxes in 2026 or tax year 2025. Her modified adjusted gross income is $158,000. That's provided to us in this problem. Now we look at the phase out. So if you remember the requirements that we just went through for the phase out was between 150 and 165. So there's a $15,000 range between 150 and 165. And since she's making 158, we're $8,000 into the phase out range, right? From 150 to 158, that's $8,000 within the phase out range. We didn't exceed 165, but we're not below 150. So we do get some, just not the full or nothing. Now, like I said, the range between 150 to 165 is 15,000. That's important. We're going to need it. So let's go ahead and determine what our excess amount is. Okay, so how much money did we make? I don't want to say too much money, but in a way, we have a modified adjusted gross income that's too high for us to take the full $7,000. So what we're going to do is we're going to say our modified adjusted gross income is $158,000 minus the beginning amount of the threshold, right? 150 out of the 150 to 165, 150. So we're at $8,000. We made too much by $8,000. So because we're $8,000 over the 150 beginning threshold, what we're going to do is we're going to figure out our phase out percentage. What we do with our phase out percentage is we're going to take that $8,000, the excess amount we just determined, and we're going to divide it by the range. It's $15,000. Okay. For single and head of household, we're at 15,000. Between 150 to 165, that's 15,000. So we divide those and we get 0.5333. All right. So now we know what our phase out percentage is. So now we can determine our reduction. So when we know our reduction, what we do is we take $7,000 max, right? That's the max that we can contribute to our Roth IRA if we made $10,000, right? So this is before the phase out. The max would have been 7,000 times 1 minus our phase out range. So 1 minus 0.5333, that gives us $3,266.67. Well, we have to round down to the nearest tenth, so we're going to be $3,260. That's going to be the max that we can now contribute to our Roth IRA, at least through the traditional approach, because we made more than the threshold. Now, like I said, there's another mechanism. It's called the backdoor Roth. And what we could have done is used a different mechanism to be able to put in the contribution on that. But again, unless I get enough comments on that, that's not a video that I'm making at this point. All right. So this is my favorite investment mechanism, just because I like to see the non-taxable growth, which is a huge deal when you start making a lot of money throughout your career, and now you have retirement and you have all this money that's coming in. It pushes you into some pretty high tax brackets. This Roth IRA is particularly useful for those that are in lower income tax brackets currently and that expect to eventually get into a higher bracket as they retire. So it's worth taking a look at. Hopefully you found this video helpful. If you did, please go ahead and subscribe to my channel for other updates and for other tax knowledge.